When we use the information from the income statement, basically we want to predict the company's future earnings. So we should investigate the quality of earnings, because some earnings reported in the income statement may not provide good, predictable information, while others may provide more useful information for predictions. The reason is some earnings may be permanent, some earnings may be just temporary. These earnings are result from some infrequent or unusual items. In other words, these earnings or losses only has temporary impact on the company's earnings. While some earnings have great quality because they are permanent, or these earnings are more sustainable or persistent. Also, usually these earnings are reported in the continuing operation. In the income statement, we report many different revenues, gains and losses, expenses, but different items have different qualities. So before we use the numbers in the income statement, we should know that some other factors which are not related to the fundamental performance of the business also have impact on the earnings. If, for example, the numbers are prepared according to accounting standards, the rules, right? The accounting standards provide somewhat flexibilities for the companies to change their earnings through altering assumptions and estimates. If, for example, the depreciation expense, the firm can just simply change the estimated useful life or residual value, so the depreciation expense to be recognized will be different. So companies can overstate their expenses currently and finally reverse those estimates to boost the future earnings. This is topic of the earnings management. Okay, so here in this chapter, you just know the accounting standards provide opportunities for the companies to make their earnings more smoother. Another is classification shifting. The company may report the non-operating items into operating items because operating income is considered more sustainable than the non-operating income, or operating income has greater quality than the non-operating income. By shifting the earnings from non-operating to operating, this will increase the company's permanent earnings, which will have impact on the investors and creditors' expectations. So in summary, accounting standards have loopholes that provide opportunities for companies to manipulate their earnings. So when we analyze the financial statements, especially income statement, we should investigate the quality of earnings. So here is a multiple choice questions. The answer is D, A, and C. What are temporary earnings? They are not likely to occur again in the foreseeable future, and have a different impact on earnings in the future. While answer B, obviously it is a permanent earnings. So here is a partial income statement for Estee Lauder. We have an income statement for the 2020 and 2019. We find the revenue reduced a little bit. Cost of goods sold increase. Because this, so gross profit reduced. Revenue reduced, cost of goods sold increase, so gross profits reduced. These changes do not account for the difference in operating income. So we find the operating income actually reduced about 1,700. So what item accounts for this reduction? Actually, here, these three. Yeah. The first one, restructuring and other charges, which reduced. Yep. This has positive impact on the operating income, but the other two has huge increase. These two totally increase almost 1,400, which accounts for the majority reduction in operating income. But we know these three items, they are related to the company's temporary earnings. So in this case, they are temporary losses or expenses. The reason is restructuring and other charges do not occur every year. The impairment of goodwill also is not frequent. An impairment of other intangible or long-lived assets also triggered by some events. So these three are not persistent items. We can see SG&A expenses are sustainable, which is correlated with the revenue. When revenue reduces, this expense also reduces. I don't know why the cost of goods sold increase, so we need to do some research, but this example communicates us that this I circled. This represents the items that are related to temporary earnings. Although this reduced operating income significantly this year, but they only have temporary impact. Usually, as a financial analyst, we will remove this temporary impact from their predictions. The reason is because they are unsustainable. And in this slide, it introduced the restructuring costs or charges, the definition and the characteristics. It includes the termination benefits to the employees to be terminated because of the restructuring and the cost associated with closing facilities and the subsidiaries. This is a result from the change in the manager's strategic plans, but this won't happen every year. There are some other items that only have temporary impact on the company's performance or earnings. It includes long-lived assets impairments, both tangible and intangible. The example here is goodwill impairments and impairments on long-lived assets and intangible assets. They have temporary impacts. They're just triggered by some events. For example, a reduction in the sales this year. While this is related to the losses or expenses, some revenues may also have temporary impact on the company's earnings. A typical income statement, just use Estee Lauder as an example. The most sustainable part is what I circled here, because these revenues expenses are directly related to the company's major business. So the next one is some other interest income, interest expense, gain, losses from sales of investment. These are more related to the company's investing activities, not operating. Although they have impact on earnings, usually they are reported in the non-operating section. They are not as material as the operating income or operating items. For example, that's the partial income statement of Home Depot. We can see operating income is over $15 billion, while the interest expense, interest income are minor. The interest expenses are from the debt, while interest income is very small. And because the company's major business is not investments, while interest and investment income are from financial investments. Statements are prepared based on accounting standards GAAP. So the earnings also called GAAP earnings. Companies may also voluntarily disclose some other non-GAAP earnings to provide a guidance for the investors and the creditors. And basically, they exclude the temporary revenues or expenses from the GAAP earnings. But it is controversial because these decisions are at the discretion of management. So when we use these non-GAAP earnings, they're useful, but you should also be careful or skeptical. And after Sarbanes-Oxley Act, when companies disclose their non-GAAP earnings, they should provide the reconciliation between GAAP and non-GAAP earnings to prevent companies misleading their investors. This is a multiple choice question for the concepts of restructuring costs. And we recognize this cost or charge in the year when the costs are actually incurred.